Whether you agree or disagree, the Federal Reserve is set to cut interest rates as inflation accelerates. As we saw last week, headline inflation in the United States accelerated to 2.9% year over year, which is a 4-month acceleration to the highest level in 7 months. At the time of recording this video on Monday, September 15th, the Cleveland Fed's Inflation Nowcast has inflation going up for a fifth consecutive month from 2.9% to 3.0% in September. This is obviously well above the Fed's 2% target, and as you can see, looking at the 5-year break-even inflation rate, the bond market right here is showing that compared to this time last year, when the Fed was cutting by 50 basis points last September, the 5-year break-even was at 1.94%, which is below the Fed's 2% target. Now, the Fed is set to cut again a year later, when it's well above that, nearly 50 basis points higher at 2.4%. Now, despite those very real signals of inflation reaccelerating or at least remaining sticky, we have bond yields falling as well as the futures market pricing in 3 rate cuts between now and the end of the year because of the labor market weakening fears. Now, my team and I are in the camp that the Fed is making a huge policy mistake because the labor market is shrinking as a whole because of lack of immigration. We also have a lot of seniors retiring, and effectively, we have not as many people participating in the labor force, meaning that lower jobs numbers is now the real normal. I would highly recommend you check out the economist Jim Bianco at Bianco Research for further explanation of this. But it's not just me that is positioning for this, it's the reason why gold is accelerating the way that it is, as well as the stock market making new all-time highs every single week, continuing its massive bounce from the April lows. We also see credit spreads at historically low levels that we haven't seen since 2007. And one of the ratios that my team and I like to track that show times of risk on versus risk off environments, which is the XLY versus XLP ratio, that is in a clear bullish trend, and it just made new all-time highs. Now, zooming into the S&P 500 on a 3-month basis with these daily candles, along with the average volume on a 1-week basis in green and the average volume on a 1-month basis in blue, you can see that over the past week, we have a volume breakout on new higher prices that is extremely bullish. Now, with all that being said, though, my team and I typically like to raise cash heading into these big events like the Fed meeting on Wednesday. And so we are starting to take some profit on things that have been working over the past several weeks until the event risk has passed. Now, when I say that, that doesn't mean that we're selling everything and going 100% into cash. That just means that we are taking profits on the most recent things that are up in our portfolios just to have cash, just in case we have a dip here.